Hey there, everybody. Welcome to my data science channel. My name is Ryan Schewel, and I discuss all types of topics pertaining to data science, machine learning, artificial intelligence, deep learning, AI, things like this. So today is I'm going to do something a little bit different. It's not really data science per se, but there is a lot of data behind this, and I think it's a very relevant question. I want to answer the age-old question of should I rent or should I buy? And this comes up all the time. You talk to people, and they try to do their analysis. Sometimes they don't even know where to get started. Sometimes their analysis is oversimplified, and they don't really understand how complex these things can actually be. If you oversimplify the problem, you're probably going to get it wrong, right? So you have to, um, handle everything appropriately, but you don't want to overcomplicate it too. So I'm going to try to answer this question to the best of my ability. I think I'm going to hit all the main points here. If you have some feedback or some recommendations for improvement, let me know. Okay, so let's jump into it. Is it better to buy or to rent? And the answer is pretty easy. It depends, right? I think I think you saw that one coming. So it really depends on um, a lot of different like criteria. I guess I would call them different criteria. So um, this analysis will help us to better um, understand and expose the types of things that we need to address to be able to make the calculations to really answer this question. Is it better to buy or better to rent? It depends, but I'll show you which is better. Okay, it depends on the scenario, and we'll get into it. Okay, and there's a bunch of reasons to do this too. For financial comparison, opportunity costs. If you rent, typically your costs, at least your initial costs, because you don't have a huge multi-million-dollar down payment, um, you'll have more money to invest in the stock market, and you could potentially make some decent returns on the stock market, right? So that can offset the appreciation on the house that you wouldn't be eligible for if you didn't buy the house, right? So there's ways to sort of counterbalance um, how you manage your money and how you do these things. So to understand real estate market trends, that's important. Flexibility, long term versus short term. How long are you going to be there? If it's a couple of years, probably makes more sense to rent. If it's going to be many years, it probably makes more sense to buy. People have different lifestyle preferences. People have different risk, like willing to accept or expose themselves to certain types of risk. Some people want risk, some people don't. If you buy a house, that could be a major expense. It's probably the number one largest expense you'll probably ever make in your entire life. Some people don't want that kind of responsibility, right? There's emotional and psychological factors that drive these decisions. And do you prefer a sense of ownership? Well, some people just want to rent. They're just renters. That's just their personal preference, right? And the last thing I listed here in my notes is personal preference. So I think I hit all the points. So I'm going to go ahead and run this script. I'll give you all the code. You don't have to take notes and understand all the details of what's going on here, but I can tell you in just a minute or maybe less. Basically, we're importing data from the S&P 500 going back 30 years. So it's 30 years of historical data, and I'm going to plot this out in a nice plotly chart. So if you go back to August, or actually July 1995, we're going back 30 years, right? We're in 2025 now. And this is where the S&P ended up. So 11 times gains, and we started at a buck over here, right? So it went from a dollar. If you invested a dollar 30 years ago, you'd have $11.56 today. I don't think anyone's putting a dollar into the market, but do the math. If you put in 100,000, you'd have 100,000 times 11, um, whatever that is, whatever that number is. Can't even think offhand. Let me see. Let me see. I'm curious. I just shut down calculator. I just shut down my Excel. Thought it was done for the day. Uh, 11. What was that? 1.1 times. Yeah, that's what I thought. I didn't want to misspeak. So 1.1 million if you invested 100,000 30 years ago. So why do I need this? Because I'm going to do a comparison pretty quickly here, pretty shortly here, between owning and renting, and I'm going to make the assumption that if the renter doesn't have the burden of saving 20% for the down payment for the house and maybe potentially paying higher payments, they can take the excess money and invest that in the stock market and generate some returns or some profits from the stock market. And I have several videos on my channel by now, a whole bunch of them about investing in the stock market and optimizing your investments and using AI trading bots to do the trading for you, and using reinforcement learning and using a couple different artificial intelligence techniques to go ahead and try to generate above market returns. And in most cases, I think pretty much every single case, the buy and hold strategy outperformed all the others. So I thought that was very interesting. I tested all the logic, forward and backwards, inside out, upside down, everything. And I believe it's right. I think if you buy and hold, you can make more money than if you're an active trader. There are exceptions to this rule. Okay, look at Warren Buffett. He's done okay for himself. He's done pretty well, actually. But for the average person, um, I think the buy and hold strategy is far better than the active trading strategy. And by the way, Warren Buffett made his money through mergers and acquisitions and corporate takeovers and strong holding, or forcing companies to do things that they didn't necessarily want to do too. It wasn't just sophisticated, intelligent investing. He was in charge of a lot of those transactions to improve his personal wealth and his overall uh, profits, right? So anyways, I think this is a good benchmark for what type of investments we can pick. And again, I'm not going to say, okay, go invest in Apple and Coca-Cola or whatever. I'm just going to say invest in the whole S&P 500, and you're going to do pretty well. Look at, obviously, this speaks for itself. You started with a buck, you end up with 11.1 or whatever this thing was before, and that's a pretty decent return. So let's assume that this home buyer or this renter, I mean the renter actually, because the home buyer isn't necessarily investing. They certainly could, but in this scenario, I'm looking at buying a house and looking at the appreciation of the house and paying taxes and so on and so forth. The renter is going to have more disposable income, and I'm just making the assumption that they're going to take that excess income and dump it into the market. Now, the homeowner can certainly do the same thing. There's no reason they can't, but the assumption is going to look at the combination of renting plus investing, or just buying a house. Okay, and there's different ways you can slice and dice it, but I think that makes a lot of sense. So we have the S&P 500 that is imported nicely. Let us go through and kick off the logic in this next cell right here. I don't even need that one. Let me cut that out. Okay. Now this is pretty nice for a variety of reasons. Number one, easily the number one, is because it's very dynamic and it captures input from the end user. So your scenario is going to be very different from mine, and different from your neighbors and my neighbors and your best friend and some guy that lives down the street from yourself and myself. Everybody's going to have different wants, different needs. So I tried to make the code very dynamic and capture these inputs, because I could easily say, okay, these are my assumptions, but if it's fixed in stone, that doesn't help you, doesn't help anybody else, right? I want to make this as dynamic as possible so anybody can use the tool. You plug in your numbers relative to your specific scenario, whatever that is, and you do your own assessment and your own evaluation. That's the best way to proceed, right? If I just give you my evaluation, that's going to help me, but it doesn't help anybody else, right? So I want this to be fully useful for anybody that touches this thing. Okay, so here is the initial purchase price of the house. I live in New York City, so houses are not cheap over here. I'm going to say 2 million. 200,000. Is that 2 million? I think so. Okay, 2 million. And again, for my scenario, that's probably pretty realistic. There's houses that are cheaper. There's houses that are way more expensive. And if you live in some small town in Oklahoma or Alabama or whatever, I'm just making up some things here, home prices are going to be drastically different. I think in New York City, 2,000 is reasonable. Enter a down payment. So when my wife and I bought the condo, we put down a pretty substantial down payment. I'm going to say 0.6. Okay, 60%, because we traded another condo, or we sold another condo and bought the current one that we have. And I think we put down about 60%, give or take. Now the mortgage, we refinanced a few years ago before COVID hit, like a ton of bricks. Everything got more expensive after that, right? And we have high inflation, high federal funds rate. So the rate at which banks lend money to mortgage borrowers is probably about 7 to 7.5% now. I'm just guessing. I think that's pretty accurate. But my mortgage is quite a bit cheaper than that, right? So I'm going to use my actual number 0.02875. But again, make this relevant to your scenario. If you're paying 7.5%, then put 0.075 in there, right? So enter the loan term. We got a 30-year fixed. Okay, personal property taxes. That's about right. Homeowners insurance. That's actually kind of cheap. We've never even used the insurance. Hopefully we don't have to, right? Insurance is the kind of thing that you can pay for years and years and years and you don't want to use it. Like if you have a car accident, that is that sends you to the hospital. Nobody wants that, right? But hopefully you're covered by insurance. You don't want to use your insurance. That's the point I'm trying to make here. You want it, but you don't want to use it. So annual maintenance costs, actually where we live, is a little bit high. You have to pay the common charge, you have to pay the doorman, you have to pay like the garbage pickup, the water charge, and everything. They roll it up. Very convenient. They make it very easy for you to spend money. But I think that is pretty accurate. The appreciation of the property is probably about 6%. In the past few years ago, several years ago, it was much higher. It's probably about 20% per year for several years. It slowed down a little bit, but I know it's not zero. The houses around here are still appreciating somehow, even though it's super expensive now. It keeps going up every year. So I think 0.6 is about accurate. Interest on the tax deduction. Oh, yes. So this is about 0.3, 30% is pretty normal. Enter the cost of selling the house. I am going to put 0.01. Now, normally this would be a little bit higher, 0.2, 0.3%. I'm going to use 1%. I'm actually thinking of doing a FSBO, for sale by owner. I'm going to talk to a real estate friend of mine and see if that's a good idea or not. But I think that is an option for us. So enter the monthly rent amount. So now this is for the renter, right? So this is on the opposite side of the coin. If you're not a homeowner, you have different types of expenses. I'm going to say about 5,000 in my neighborhood. That's pretty accurate. Annual rent increase is probably about 0.033% increase per year. Security deposit, that is equal to the rents. Okay. And there's cheaper rents out there. I'm not saying everything is 5,000, but that's probably pretty accurate. And renter's insurance, this is going to be pretty low. Okay. Maybe $300. It's not a big one. So I put in everything, and this tool is going to do a nice calculation for us. Now, remember, I paid in my scenario here, I paid $2 million, 60% down. So the first payment out is $1.2 million. And after that, I have the taxes, I have the homeowner fees, I have what else? Condo charges, common charges, they're called, things like that. So I think after the initial charge, you still have cost of living expenses, right? But it's going to be totally different from the renter. So I'm saying the first year, 1.2 million out for the renter. It's 5,000 per month times 60 months. Now that is going to go up for the next year. This is cumulative out. Okay, it's not going from 60,000 to 123,000. This is cumulative for the renter. For the homeowner, it takes a big dip down at the beginning, right? You're not paying 1.2 million per year. But here's the associated mortgage charges, right? Because you're going to have to pay interest on the mortgage and the common charge and taxes, right? So the homeowner is going to be subjected to very different expenses than the renter. But I think, based on all these inputs over here, I think this is pretty realistic in New York City, certainly not in my neighborhood. Now, again, the renter is going to have the option to invest the difference between what they pay for the what they save on the mortgage and what they pay in rent. There should be a gap in there, right? Because the homeowner is probably going to have higher expenses. So I'm assuming that the renter is going to put away 10,000 per month. I'm sorry, 10,000 per year, and consistently do that consistently for 30 years, and it's going to grow over time, a little bit at first, and then grows faster and faster and faster. So if we go down here at the end of 30 years, we see the homeowner has spent 1.28 million, 1.27 million. The renter has spent 4.24 million, but they have a portfolio of 1.6 million. So that kind of offsets some of the expenses here. The homeowner, of course, can sell the house at any point and get back the original investment. The renter can't sell anything, right? So they're kind of missed the boat on that. But again, they have the portfolio, and certainly at the beginning, their expenses were way less because they didn't have this big charge in year one. I had to pay 1.2 million Any renter that falls into this bucket over here pays 60,000. So that's a big difference. Okay. So in this next chart, I'm going to run some code that gives me some control over all of these inputs and then plots everything so I can see visually what this thing looks like. So again, it's very dynamic. Again, I was capturing a bunch of inputs from the user at the beginning with those input boxes and doing all the calculations. And I'm making this very dynamic too to try to illustrate the point of what it's going to look like for the homeowner and for the renter over a 30-year period. And it's kind of hard to estimate over 30 years. That's a long time, guys. But we can start to make some assumptions to try to understand, is it better to rent or to buy? So if I change some of these slider controls over here, and again, all these controls are pretty dynamic and interactive. So where's this thing? So if I take a quick look here, renting is more expensive than buying, right? But if I increase the cost of the house from 2 million up to close to 4 million, let's see what kind of impact that has. Now buying a house is much more expensive, right? If I reduce that down, if I live in a cheaper house, it's only 1 million. Now the renter is paying a lot more money, right? Because they're paying 60,000 per year. I pay 1,100,000 for the house, and it has some taxes and some home ownership costs, but not as much as the renter, right? So now the renter is losing, the homeowner is winning. If I put down more of a down payment, then my monthly mortgage payments month to month is going to be a lot less, right? So if I put down almost nothing, the mortgage payments are going to be more per month, right? If I put down most of the money, the mortgage is going to be basically close to zero. It's a much bigger down payment, but money out every month is much less, okay? So I can change that. If the mortgage rate increases, then the house is going to get more expensive. Mortgage rates are high. It's about, I think 7 to 7.5%. If I push this up to 10, you can see it's blue line, which is the cost of buying the house is much higher, right? And if I push this down to 1%, that's not very realistic, but you can see now the house is much cheaper. So we can adjust the mortgage rate long term. I think 30 years is fine. I'm going to leave that. Annual rent increase. Now, if you increase the rent for this guy over here, renting becomes way more expensive. If you go down to 1%, if this guy gets a sweetheart deal, now the rental guy is almost equal to the home buyer. Okay, the renter and the home buyer are the same, and I added in some values here too. So if I change the real estate taxes from 12,000 to 1,000, now the house becomes a little bit cheaper. If I pay no taxes, that's not really very realistic, but now the house becomes even cheaper. If I pay a lot of taxes, let's say 60,000, and that's not unheard of on Long Island. People have expensive houses and pay a lot of taxes. Now the house is way more expensive, right? Homeownership insurance, that's not going to change that much, I don't think. We have annual maintenance costs. If I get some kind of deal and that goes down to 1,000, now the condo becomes cheaper or the house becomes cheaper. And if I add that up to 10,000, right, it's going to become more expensive. And that orange line is changing because the house is changing, right? If I put that up to annual maintenance cost for the house is 100,000, now the house gets very expensive. It almost looks kind of an illusion. It almost looks like the orange line is changing, but it's really the blue line changing relative to the orange line, okay? So all these controls are pretty dynamic. You can test this out. Expected rate of return on the market, if you pump that up to about 0.12%, now your investments are doing much better, right? And if you push this down to 1%, 0.01, now the investments are really lagging. And if the monthly rent goes up to, I don't know, 10,000, some people's rents are actually 10,000. Now the rent becomes, the guy renting is paying a lot more than the guy buying. So hopefully that's it. Hopefully it makes sense. Those were my thoughts on whether it makes more sense to buy or to rent. So hopefully that was insightful to you and useful and informative and somehow educational as well. Okay. Try to make all my videos entertaining, but mostly educational. That's my focus. Try to make it a little bit entertaining if possible. Like data science and finance topics aren't necessarily entertaining. They're educating if it's very educational, but is it entertaining? I don't know. That's kind of debatable, right? And then my closing notes here, the last thing I have is renting. Total costs could accumulate over time as the rent increases. The mortgage is fixed, right? If you get a fixed mortgage, you could get an ARM, which is an adjustable rate mortgage. And then after a certain period of time, 5 years or 7 years, the ARM could adjust up or down. All right. But if you get a 12-year, that's fixed. So you kind of lock in that rate long term. So there's a few things to consider for buying and renting in that scope, right? Buying total costs accumulate. For the homeowner, right? As the home gets older and older, you could have more things breaking down, so it could become more expensive over time, and the investment value could accumulate at different rates, right? And we just saw this. If you change your expected return on investments to 10%, then your overall investment portfolio is going to jump up more and more. So you can make these kind of assumptions. Just try to make it as realistic as you can, and the output will be realistic too, right? If you come up with some crazy numbers, then the calculations are going to look kind of crazy. So you want to make this as accurate as you can. Um, I think it's very easy. I think you just interact with the tool, you do what it tells you to do, and you get your results over here. And you can see, is it better to buy? Is it better to rent? For me and my wife personally, it's significantly better to buy our place than renting. But for different people, it's gonna be different, right? Some people um, are really going to make out much better by renting, especially if you live in the neighborhood just short term for a year or a couple of years. You don't want to go through the hassle of buying a house. And if you rent, it's pretty cheap. It just makes sense to be a renter, right? But in some cases, it's really going to be a much better, um, much more intelligent decision to become a homeowner and to stick it out because you own that asset. And when you sell that down the road, 10, 15, 20 years, maybe 30 years, it's probably going to appreciate in value significantly. And you're going to have a huge payday when you sell your house and downscale to something smaller or move to a cheaper city, right? So those are things to consider too. But it's all baked into the analysis. Everything is integrated pretty tightly. And I think it summarizes um, everything pretty well and answers that question. Should you buy a house or should you become a renter? Okay, so that's it. That's my findings. Just want to share that with you guys. I'm going to wrap it up and I will see you in the next video. Bye.